All right, in consumer news today, the Federal Reserve has suggested that it may raise interest rates even higher later this year. If it does, what does it mean for you and your money? Joining us with some of those ideas of what you can do to protect your portfolio is our business and money expert, Derek Kinney. Derek, it is good to see you today. Thanks for joining us as always. We appreciate that. First of all, tell us why the Federal Reserve still wants to raise rates after not doing so at its last meeting last month.
Well, first of all, great to see you, Jason. And it's on the mind of so many consumers right now. If they stopped raising rates, what would cause them to continue? And here's what the Fed chairman said is they wanted to take a brief pause to assess how are the rates impacting the economy right now. And the worry is if they were to raise rates too quickly, it could actually engineer a recession, which is most economists and most consumers' biggest fear given some of the tough economic times many people are facing.
And a lot of people wonder whether we're actually going to have a recession. No one really wants a recession, but when the Fed raises rates, what impact will that have on the economy, Derek?
It affects people in different ways. First of all, if you have a credit card, you'll first feel the pinch here, especially one where the rates vary every single month, those adjustable rate credit cards. And in that situation there, Jason, you want to try to pay that off or move the balance to a fixed rate card as soon as possible. Also, you're going to see slightly higher rates in checking and savings. You know, back in the day, you used to maybe get pennies on the dollar in interest. Now those are higher. You're going to see higher CD rates. So typically those fixed income rates tend to go up as well. But also, if you're going to buy a car, you're probably going to pay more to buy that car as well.
And even though rates are high, some people are still out shopping for homes right now. How does it affect them?
Yeah, that's going to be one of the biggest pinch points that people have financially, Jason, because we see right now inventory is still low. Prices for houses are back to almost all-time highs again because the inventory is so low. There's few houses, demand is high, it's going to drive it up. So if you find a great house in a great neighborhood with great resale value, I would tell people even better now to pay the higher interest rate because eventually when things do settle back down again, which they will in the future, you could always refinance it, but at least you've got the house of your dreams that you probably could see some appreciation on over the next couple years.
Yes, you can always refinance. People should remember that. And what about a person's 401k or a brokerage account or other investments? Is there a money move to play here?
Well, I wish I had a crystal ball in front of me here, but the biggest worry right now, Jason, is if the Fed overplays their hand. If you're in Vegas and you play, one card too wrong, that could actually ruin your entire hand. And the Fed is worried about that is if they make one false move, it could cause the economy to dramatically slow down. And if that fear is real, being diversified with your money is the number one solution people need to have. Talk with your financial advisor who knows your goals, your dreams, your risks, and craft a plan to make sure that that is encountered in your portfolio. Because if not, and the market were to drop, you could be left holding the bag, which is exactly what we don't want for our viewers.
Indeed so. Derek, we always appreciate your expertise. Thanks so much. We appreciate it.
My pleasure. Thank you, Jason.